It was quite a back and forth week. We had the Powell testimony that seemed to indicate we were going to go higher. We had the jobs numbers, and then we had the SVB situation. What do you make of all of it?
Look, I think that the overwhelming thing that happened this week was the receivership of SVB, right? It's one of the largest bank failures that we've had since the financial crisis. It's the 16th largest bank in the U.S. I don't think that the issues that you see with SVB are systemic. I would agree with what Larry Summers has said earlier. However, I do think it was an opportunity for everyone in the market to take a very big pause today and really think about their positions and think about their liquidity, which is why you saw some of the, less liquid parts of the market really get hit much harder today, like small cap stocks and high yield bonds also, were down pretty dramatically today.
So, Sarah, even if it's not systemic, is it possibly a canary in the coal mine, as they talk about? Although it may be just SVB and they got special situations, the underlying circumstances could be reflected in other parts of the economy, as well as, frankly, financial markets.
Well, David, one never knows, but Silicon Valley Bank did have a very concentrated corporate deposit base, and so there are other regional banks in the U.S., their deposit bases in general seem to be much more diversified. So that's one of the primary reasons why this may not be systematic. But confidence is crucial for banks. And there doesn't appear, especially given the likelihood that Silicon Valley Bank depositors will be made whole, any reason for this to spread through the banking system, which could be a reason to be looking at some of the other banks as investments, given they're selling off so rapidly.
Well, it wasn't even, I don't think, as a practical matter, Sarah, by the time it started to sort out, it looked like the regional banks were getting hit harder than the big money center banks. Does that suggest that some of the regional banks may be opportunities for investors right now?
It does depend on what they hold. If in their asset bases, they have a huge amount of commercial real estate, particularly office, that could end up being very problematic. What we're all really talking about here is a new era. Interest rates are rising, and until they stop rising and fall again, there's a complete new view on credit. Credit is going to be very difficult to obtain. We're in a credit crunch. So whether you're in real estate and you have a tough time with occupancy, or you're a technology banker, this is a whole different environment. So be really careful if you're looking at regional banks. Make sure if they're trading down at their tangible book value, book less goodwill, that's really solid ground. There's nothing else that could go terribly wrong on their asset side of their balance sheet.
Barbara, what other parts of the economy and of business are interest rate sensitive in this sense? Because we've had a long regime, frankly,
right,
of pretty low interest rates. That seems to be gone.
Right. Well, look, who's benefited the most from very low interest rates? The real estate sector was probably the first one, right? That's the single biggest beneficiary of it. You'd have to also take a look at the private markets. Private credit, private equity, private real estate all benefited from very low rates. So, the fact that you have is drying up liquidity. The Federal Reserve has been raising interest rates aggressively for the past 12 months. They're trying to slow down the economy. And when you slow down the economy, certain things break. Just like cryptocurrency broke last year, then you had the problems in the gilt market in the UK, and now you have a U.S. bank that's just failed.
Try to slow down the economy. How much, Barbara? Are we going into a recession as a practical matter? Because the inflation seems to be more durable than people thought. Mm-hmm. Are they going to have to step on the brakes so hard that we have to go into recession?
I don't think there's a recession on the horizon over the course of the next 12 months, right? There's a very long lead time between policy implementation when you're raising interest rates and when you would go into recession. The U.S. economy is extremely strong, right? You had 311,000 jobs printed this past month. While it looks like the labor market is starting to ease a bit and weaken a little bit, I would say that the U.S. economy is a very durable supertanker. It would probably take a seismic shock of some sort in order to derail it at this point, and I don't think SVB is that shock.
Sarah, you specialize in equities in particular, investing in equities. When it comes to equities, what is your base case on recession? And more importantly, does it matter? Does it really affect which equities you invest in, whether you think there's going to be a recession or not?
It matters if a stock doesn't already price in some slowing. There's no doubt. I mean, my colleagues and I really do believe that the Fed is intent on slowing the U.S. economy. And the same with the European central banks. Maybe they're a year behind the Fed. And at some point in time, maybe the Japanese will tighten monetary policy with a new central bank head. So there's a lot of tightening out there. And the other side of that is typically economic slowing. That's what brings down inflation, and inflation is the target. So we're expecting some element of slowing. It may be severe. It's hard to know. But what we do know is what's priced into stocks. And not all stocks, but in certain areas, many of them have already discounted an economic slowing. Not all the cyclicals, for example, but there are sub-industries that have. And that's the opportunity where it's already priced in. Then we can have it. Then the worst can happen, and the stock has nowhere to go but up.
So, Barbara, let's play the parlor game. What do you think the terminal rate's got to be for the Fed to get inflation down to where it needs to go?
I don't think it's as high as probably what the market's pricing in. I think maybe the Federal Reserve has to tighten one, maybe two more times, if that, and then be done. The reason is the way that you price in a higher terminal rate is either you have faster labor force growth or faster productivity growth. The U.S. doesn't have any showing of that being the case at this point. So for us, we do not believe that our star is 6% or something above there at this point. I don't think that the U.S. economy can grow so fast, or it's been such a dramatic change that it's been over the past 20 years. So we don't think that rates have to go much higher at this point.